Okay, welcome back. This is session 3 of chapter 3 from Gapenski. So we're going to wrap up chapter 3. We're going to finish talking about the income statement. This is the first of 3 or 4, depending on how you want to count it. We have 4 financial statements that we'll talk about. We're going to be heavily focused on the income statement and the balance sheet, which comes in chapter 4, but we'll talk a little bit about cash flows today and in chapter 4. As well as the statement of changes in owner's equity. So let's go ahead and get going on that. I'm going to share my screen, if I can remember how to share my screen. All right. Share. Let me see. Alyssa, can you see the, okay, you're nodding. All right, good. I'm going to minimize here. Okay, so we went through the first section. I told you there are 3 sections of a standard income statement. The first section is the operating revenue. So we did this yesterday. So very quick review. You're going to have a top line. That's going to be your revenue, your core revenues. So think about that top line is always going to be the core revenues from the organization. Whatever the organization's primary reason for existing, the raison d'etre, or whatever, how the French say it, right, is what's going to go in that top line. So hospitals are going to likely have, and we're using a hospital as an example here, hospitals are likely going to have multiple sources of income, right? But the dominant one is going to be patient service revenue, and that's going to be true for say clinics as well, right? And then you're going to see a different thing at the top for other kinds of organizations, right? So I talked about insurance companies. They're going to have a different top line. It'll be their revenue from premiums collected, right? So you'd see that at the top because that's their core business. You're going to have a different, you're going to have something else for nursing homes, but it'll still be, it'll be revenue from generated from, I forget the phrasing right now that they use, but it's revenue generated from residents, but that's not the right phrase. But it won't be patient service revenue because they're not really patients, they are residents, right? So it's a little bit different, right? But whatever the core business is, that's going to be the top line. Now, the thing that I want to remind you about with hospitals and clinics in particular is because there is a hidden line that shows up here that what we used to include called the gross patient service revenue, right, which is based on the charge master. And we talked about the charge master being this document. It's basically like a great big spreadsheet that all of the hospitals and clinics have that says, a 99214 we charge $200 for. And everybody knows that they're not really going to get $200. And the reason they have that grossly inflated number on the charge master is because it's really like a starting point for negotiations with the insurance companies. Because the insurance company is going to come and say something like, we'll pay you 60% of whatever your charge master says, or $100. And so what the hospital is going to do is they're going to mark up their charge master to maximize whatever the contract with the insurance company says it's going to be. They literally do that. I helped a hospital do it when I did my internship many years ago, right? That was one of the assignments I had was look at our look at our highest paying insurance companies and then reset our charge master so that we maximize our billing. So everybody knows that the charge master is just a starting point for negotiations. If you've ever shopped for a car, particularly a new car, right? There's a sticker on the window that says, what is it? Dealers suggested, is it manufacturer's MSRP, right? Manufacturer's suggested retail price is, $8 zillion, right? Something ridiculous. That is all that is a starting point for negotiations. And so that's what kind of gross patient revenue is. We all know in the industry that that's a bunch of hooey, right? And so we don't even put it on the income statement anymore. What we put on the income statement on that very first line is net patient service revenue, net of contractual allowances. Contractual allowances refers to the negotiated price that you are actually going to expect to get from your insurance companies. I'm saying this again because it's so important. I know we talked about it last time, but I want you to hear it again, okay? Also included in that reduction from gross to net of contractual allowances is your charity care. Okay, so the charity care is also not included in that. Then you get down to the NPSR net of contractual allowances and discounts. Then you get the provision for doubtful accounts. That's the provision for doubtful accounts is people who we believe should have paid, could have paid, and didn't pay, right? So these are just our bum, clients that we think should be able to pay and just haven't. That's different from charity care. Charity care is already accounted above the top line here before in the area we're not even seeing. Now, if you are looking at a real hospital's financial statements, there's a lot of action that happens in what we call the notes sections. So there's going to be like a little, like a little footnote indicator next to net patient service revenue, and you go down to footnote number 42, and it says our gross, patient service revenue was 800 million. And then we had contractual allowances of 440 million or something like that. And then we had charitable care of 20 million, which then we subtract, and that gets us down to our net patient service revenue, net of contractual allowances and discounts. And they just put that in the footnotes. So it is there in a real income statement, but it's down, kind of hidden from view, okay? So provision for doubtful accounts is different than charity care. It's not the same thing. I want to highlight that so you know that. Then we get down to other revenue. What we say other revenue was for a hospital, stuff like the cafeteria, parking fees, gift shop, and then maybe some other services that the hospital renders that are not directly related to patient service revenue. Okay. Disproportionate share funding, better known as DISH funding, is compensation from the state meant to offset your Medicaid burden, right? I want you to hold that one in mind for a minute because we're going to see it come back in the next section. Okay? And I want you to, the phrase I like to use is, what the government giveth, the government can taketh away. Okay, so we're going to see in a minute, this is a gift from the government. We're going to see in a minute how the government funds this line of disproportionate share funding in New Hampshire. And by state, it's different. All states have a DISH funding. The mechanism whereby states fund the DISH differs across states, and I'll show you that in a second. Net assets released from restrictions used for operations goes back to what I explained earlier or last time was this is typically a gift from a wealthy donor to a charitable organization like a hospital. So Wentworth gets gifts from wealthy members of the community. You took care of, my ailing aunt, and you did it so well and with such dignity that I want to give you a gift in her memory. I'm going to give you $5 million, but but it comes with strings attached, right? You can't just use it for anything you want. You can't just use it to help pay for operations or whatever. What you have to do with my gift for my failing aunt was I want you to name a new, the cancer center after her, right? She had cancer. I'm going to give you $5 million. If you want to build a new cancer center, you have to name it the Samantha Cancer Center in honor of my ailing aunt, right? My Aunt Samantha. So that becomes a temporarily restricted gift. And we'll see more of this stuff later in the balance sheet, but it becomes a temporarily restricted gift and they can't use it right away. So what this line represents is they've met the requirements for a temporarily restricted gift of some sort, and that money has now been released to them to use. So whatever that was that they did, they had $111,146 that year that the gifts had been restricted. They met the requirements for the gift and it released the gift to them to use. And so that's what that line represents. So then that gives us total unrestricted revenues and other support. That is nonprofit speak for total operating revenue. Okay, So this whole section is focused on operating revenue, the revenue coming from operating the organization. Now remember, when we go back up to that top line, that second line, provision for doubtful accounts, that's not an expense. We're going to talk about expenses in a minute, okay? That is not an expense. A lot of students get confused. And they say, oh, that's, I give you, I'd say, okay, they had a provision for doubtful accounts, and okay, that's a negative. Oh, that must be an expense. It's not an expense. It's an adjustment to the revenues collected. So it's not an expense. It's not an expenditure the organization is making. It's just an adjustment. They're saying, we know that there's some percent of our revenues that we're just never going to collect. And so that's what that is. Okay, so I just want to keep hammering it. It's not an expense, because we're going to talk about expenses now. Okay. So the first section was operating revenues. The second section is operating expenses. So we're going back to that matching principle, we're going to match expenses to the revenues, right, that are generated. So we have all these revenue. We have $344 million in revenues that we generated, right, in that year. Now we're going to talk about the expenses that were associated with generating those revenues. So what are what's the number one expense in a healthcare organization? It is always going to be salaries and benefits. It's people, right? Because healthcare is a service industry and it relies heavily on people. Every hospital, every major clinic is going to have the number one expense is going to be its people, right? Salaries and benefits, salaries, and in this case, we've got it broken out, salaries and wages, and then fringe benefits. Those two are often lumped together in one line. Let me make a point here. There's a lot of kind of decision-making and art to developing these things. This is one small decision that the person putting together the financial statements can make a choice about. Do I want to show salaries and wages by itself and then have another line for fringe benefits? What's an example of a fringe benefit? Anybody think off the top of your head? Healthcare, health insurance, right? That would be a fringe benefit. Life insurance, right? Disability insurance. So a lot of the insurances that you hope to, eventually get when you get a job, a full-time job, all those kinds of things, that lumps into fringe benefits. So some organizations are going to lump it all together as salaries and benefits, right? Some are going to break it out so that you have salaries and then benefits. Doesn't really matter. As long as if you see a line for just salaries, you probably know, okay, the benefits are probably rolled in here, right? So there's a little bit of art to this, but right, so we've got salaries, we've got benefits. So benefits here is a little more than 25% of salaries. That's a common ratio. So like when you get out into the field and you start working on business plans for the organization you're working on, and you start making estimates like, hey, you know what, we'd really like to start this new service. We've got to hire 2 nurses. Nurse salaries are $80,000 a year. You would be mistaken if you just plugged in 80,000 for the nurses based on, well, nurses make 80,000. Nurses make 80,000 and then they get 25 to 30% benefits on top of that, right? So, the wedge that you would put into a business plan would be 80,000 plus 30% of 80,000, which would be what, 24,000? So the actual salaries and benefits that you'd have to put into your business plan would be 104,000, not 80,000, right? Okay. So you've got salaries and benefits. They could be lumped together, but they're going to represent the lion's share of expenses. And look at what we're talking about here. 148 plus 41, that's $189 million in salaries and benefits. And our total, after allowances for doubtful accounts, our total revenues is 329. So they're spending like what, 60% of what they earn on people. It's a big deal, in a healthcare organization. So when you hear, we're aggressively managing our workforce, there's a good reason why they're aggressively managing the workforce. It's their biggest expense that they have to manage. Okay, so salaries and benefits, kind of your top two lines. Supplies and other. So it'd be, this is an example. Supplies is going to be probably one of your biggest ones. What did I say last time was the biggest component of supplies? So you can have supplies broken out in a bunch of different ways. If we roll up supplies, what did I say was the next biggest expense for a hospital? Remember? These are useful factoids. So pharmaceuticals is going to be your next biggest. So pharmaceuticals fall up under, going to roll up under supplies. And that's going to be your next biggest expense in terms of supplies for a healthcare organization or a hospital in particular, by a margin of probably like 3 to 1. The next biggest is going to be your OR, because you've got all these $500 screws that the orthopods use when they do a knee replacement, and all these things that are really, orthopedics is really expensive, followed by cardiac stuff. So so your OR, the supplies used in the OR are going to be the most expensive, and then you're going to rack down. You're going to if you're analyzing an organization, you're going to kind of look at, where are all my supplies going? Well, pharmacy is going to be the biggest one, and that's pharmacy supplying the OR, it's supplying the inpatient wards, it's supplying the retail operation, all that stuff rolls up there. Then you have the supplies going to the OR, and then you have medical supplies going across the rest of the organization. So typically when you're looking at and analyzing an organization like a hospital, you're going to be thinking about supplies. You're going to be thinking about pharmaceuticals, medical supply, other medical supplies, and then non-medical supplies. So stuff like paper, Sharpies, all the other stuff that you're going to use throughout the organization to just run the organization. That's the smallest number. Now, here's one of the interesting things. If you wind up being in finance, working on budgeting, when I would do budgeting for supplies, I used 3 different rates of inflation, right? Because if I spent $100 million this year on supplies, I needed to make a projection for next year. If I assumed the exact same level of utilization in my organization, right? Because utilization should drive the amount of supplies we need, right? Utilization meaning, how many patients did we see? Well, so every time, Allie and Emma come through the hospital, we're going to use up a certain number of supplies, kind of not necessarily knowing, oh, Allie's going to cost us this and Emma's going to cost us this, but kind of on average, we're going to have this idea of how much money we're going to be spending per patient on supplies. If I spent 100 million last year and I expect to have the exact same number of patients next year, I'm going to have to project for an increased amount of on supplies. Why? Inflation, right? Now, you all have lived through a period of incredibly low inflation. Your lifetime has been characterized by incredibly low inflation. When I was a kid, I remember between my, what was it, like 3rd grade and 4th grade. So it was like the summer of 1979. I would ride my little Huffy bicycle down around the block to the corner store, to Johnny's corner store, and at the beginning of the summer, could go in there, with my newspaper route money, and I could buy a candy bar and a soda for 25 cents each. By the end of the summer, I'd ride my little Huffy down to Johnny's, and a candy bar was 50 cents, and a soda was 50 cents. And now I was spending, twice as much by the end of the summer. We didn't have 100%, that would be 100% inflation. We didn't have 100% inflation. That's not how inflation works, but it works kind of on individual things happen. In the 70s, inflation was insane. We had 12, 14% inflation rates. To get a loan, so some of you probably have car loans. Car loans would have been running at typically when a bank sets a interest rate, and we'll talk a lot more about this in finance too. When a bank sets an interest rate, part of the interest rate is inflation, because they've got to cover inflation, right? So imagine you had 14% inflation going. What would your car rate be? Well, if you're a young person buying a, jalopy, and you don't have really steady income, they're going to jack that rate up. Your car loan is going to be 18%, right? Think about that, as opposed to probably what you're paying now is like probably 6% or 5%. Okay, so coming back to my discussion about supplies, if you look at supplies for a hospital, I used to have 3 major categories of supply. That would have been pharmaceutical supplies, medical supplies, and then all other kind of non-medical supplies. So we would typically use the baseline inflation rate. Have you guys heard of the CPI, Consumer Price Index? That is probably the most common measure of inflation that we typically talk about. There are several other measures of inflation, but the CPI is probably the most common one. It has been running at about 1.5% to 2% for most of your lifetimes, right? When I was your age, and prior to, when I was your age, it was running around 5%. It had come down from its historic highs in the 70s at, somewhere around 15%. But CPI, is kind of that generic inflation rate. When people talk about inflation being at about 2%, what they're really saying is the CPI came in at about 2%. Like I said, there are other measures of inflation. We'll talk about those later on, but that's one you should know if you don't, so now you do. Okay, CPI is probably the most common measure of inflation. So I would apply probably the CPI or one of the other broad measures of inflation to my non-medical supplies. Then I would look for explicitly what is the inflation rate on medical supplies, and that would be applying to all of everything else that's not pharmaceutical. So it'd be looking at everything from surgical implements, bandages, and everything else that's not a pharmaceutical. That's typically, so the numbers I was using back in the day, back in the, early to late 2000s would be something like 2 to 3% for CPI, probably 7% for medical equipment, and then pharmaceuticals were and continue to have a very high rate of inflation. So probably, so maybe 2% for CPI, 7% for medical equipment, and 10% for pharmaceuticals. Right? And it's important, if you're spending more than half of your supply budget on pharmaceuticals and your supply budget is $100 million, choosing between 10% and 2% makes a big difference in terms of how you allocate your money. So this is a little bit of kind of forward thinking for you guys to start thinking about. The key here is you're always going to be looking for a supply number. You might see inventory on here instead, inventory expense instead. Those are kind of, I'll use both of those when I talk, and you'll see them on different examples of income statements that your book uses. Okay, then you have depreciation and amortization. We're going to focus primarily on depreciation in this course. Amortization basically is basically the same thing. What's the difference between what is depreciation? Then I'll talk about amortization. So we talked a little bit way back when I think in chapter 1, might have been my own lectures in chapter 1. Depreciation is the charge that we take in each year for long-lived assets. Okay, so what's a long-lived asset? Anything that lasts more than a year, anything that you expect to have last more than a year is going to be depreciated. Okay, so let's take an example. A simple example is the building that a hospital is in, right? Or the building that your clinic is in, or the building that your medical equipment factory is in, right? That building is going to cost you a really big number, right? A really big number. A new hospital is going to cost you $150 million to build, right? You're not going to charge yourself. Let's say we build that building. I think I used this example almost identically last time. We're not going to build that building in 2020, build it in 2020 and charge ourselves $150 million on our income statement as an expense, right? Put it in here. New hospital, $150 million. right? That would wipe out all of the revenue for the year. They would show up as a massive loss in 2020, right? It would look like a massive loss in 2020. And then in all future years, right, starting in 2021, you would no longer have a charge for a hospital. So then it would look like the people running the hospital starting in 2020 were idiots, and the people running the hospital for the next 20 years would look like geniuses, right? Because they wouldn't have the expense of the hospital. Remember, one of the principles of financial accounting is matching the expense to the revenue. So the reality is the hospital building is a long-lived asset. It's going to provide economic value over a long period of time, right? 40, 50 years. The standard IRS allowance for a building is 39 years. So you would, if you were a for-profit entity, you would depreciate your hospital over the course of 39 years. So if you bought if your hospital cost you $150 million, you would divide $150 million by 39, which I don't know what it is. It's probably like $3 million a year-ish, right? You know, roughly a little more than $3 million a year. You would charge yourself about a little over $3 million a year in depreciation, okay? So you've really already paid $150 million in 2020. You built your new hospital. It cost $150 million. You really paid that in 2020. But that's not going to show up on the $150 million is not going to show up on the income statement. It's going to show up on the balance sheet, which we come to in chapter 4. What you're going to charge yourself in 2020 is the value, the portion of the value of the new building that you used up in 2020, which would be, we're going to estimate using what we call straight line depreciation, we're going to estimate to be a little over $3 million. So the portion of depreciation that would show up here, if we were building that new building, would be about $3 million. It wouldn't be the full $150 million, because that would distort our view of how well run this organization actually is, okay? So depreciation is a charge that we charge ourselves on the income statement to represent the economic value that's used up of long-lived assets. Now, if you have a short asset, a short-term resource, or a one-time thing that we're going to use up, so for example, bandages, syringes, needles, pharmaceuticals, those are all expensed. Meaning you use them and they're done and they're used up and the rule here is if you're going to use this thing up within a year, it's going to get expensed, meaning it's going to show up. The full value is going to be charged in the period on the income statement for the period it was used up in, right? So if I give a flu shot to Caitlin, I expense that value in the year that I gave the flu shot to Caitlin. Right? It's not going to be used over the course of multiple years. So I don't depreciate the flu shot. I don't depreciate my inventory, my supplies. My supplies are expensed. The full value of the supplies that I use gets charged in the period that I use it. But I've got a lot of stuff in a hospital that is going to hang around for multiple years. The building is kind of the biggest and longest lived one, but there's lots of other stuff. There's, you know, physical desks and furniture that's in the hospital. That gets depreciated over a particular number of years. Hospital is loaded with computers, right? Every time you see your doctor now, he's on this EHR, right? Well, that computer is a long-lived asset. I think it's a 5-year asset. I could be wrong. So if that computer costs $1,000, they're going to take a depreciation charge of 1,000 divided by 5, right? $200 a year for that one computer. And so you go through the whole hospital, the MRI machine, probably, I don't know what the depreciation schedule is for an MRI machine, but let's say it's like 10 years, right? It costs $1.5 million. They depreciate it over 10 years. So every year you take $150,000 charge in depreciation. You really paid $1.5 million in the year you bought the thing, but you don't put that $1.5 million on the income statement. What you put on the income statement is the portion of the economic value that you are imagining that you used up in that first year that you bought it. So you charge yourself 150,000 in depreciation. So you go through your whole organization and you add up all the depreciation, right? So there's somebody in your property management shop is managing your facilities shop, I guess we call it in the civilian world. Your facilities shop is going to have a tool to keep track of all the property in your organization, and it's going to have built into it the appropriate depreciation rates, and those dollar amounts are going to flow over to your finance shop so that they can put together that line, depreciation and amortization. So depreciation applies to physical things that we can touch. Amortization is exactly like depreciation, except that it's for things that are, the word's not coming up, non-physical. So intellectual property is a good example. Let's say you pay, you're going to build that $150 million hospital. You're going to pay a architect firm $5 million to draw up the plans. I'm just making numbers up. Let's say it's $5 million. To draw up the plans and provide consulting services over the course of 3 years of building the building. So you're going to pay them $5 million. The architect doesn't hands you some paper with some ideas on it, or better yet, they slide you a file, right? They're sending you electrons, and you're paying them $5 million for electrons. You can't touch the electrons. So what amortization applies to is typically stuff like intellectual property, services that the organization got, that is of high dollar value and provides a service over a long period of time. So the architectural fees are going to be depreciated at the same rate as the building itself, right? So that $5 million is going to get spread over 39 years, not expensed in the year you pay the architect to do the work, right? Now, if you pay housekeepers, right, that's not intellectual property, and it's not physical property, right? That's a service. You're going to pay that, and you're going to pay that in the time that the services are provided. So you don't amortize things like housekeeping services. You amortize things that have they're high dollar and long-lived value. Emma. Okay, good question. So Emma's asking, for people in Zoom, Emma was asking, you don't pay your housekeeping, you don't amortize your housekeeping, but if you outsource something else like cleaning your windows, would you amortize that? No, the answer would be no. That's an expense in a given year, right? Because you're going to do it this month, you're probably going to do it again next month, right? It's a thing that doesn't deliver long-term economic value to the organization. That's kind of the key there, is does the service have some sort of long-term economic value to the organization, or is it an immediate thing that's used up and then we're going to do it again next month or next week or tomorrow, right? In that case, so even if it's outsourced, which is kind of what you're talking about, right? So even if I contract out some service, landscaping, that's not going to get amortized. That's just going to get expensed because it's the full value is really used up in the period that we're talking about. But if you have, say, legal fees to incorporate or something like that, that would potentially be amortized. Okay. It could be, so Caitlin's asking, what about a consulting firm coming in and helping you with improving your maybe expense control or something like that? I would say no. That would probably be expensed in the year it was done, but it really kind of depends on the project. The point being is the key to understanding amortization is very much like depreciation. Is the value of the thing that you are paying for, in this case, this thing is typically intellectual property of some sort, intellectual or non-physical. So it's a service, but it's or product that is not a physical asset. Does it have long-term value? Can you allocate it to a particular, typically a project like building a new building that's going to have value to the organization over many, many years? Now, maybe a consulting firm coming in and giving you some advice would have long-term value. You still probably would expense it as consulting fees in the year it was done. But we get into a gray, so you know, we could keep pushing on this. Well, what about this? What about it? Don't worry about it too much, other than just to remember, amortization is just like depreciation, except it's for stuff. It's for services and intellectual property that are non-physical and have multi-year value, and so that would be incorrect to say that that we should expense the full cost of this service in the current year. I'm not going to ask you to nitpick on this. I just want you to understand, you know, when somebody says depreciation and amortization, I want you to understand, oh, amortization is just like depreciation, except it's for non-physical stuff, sometimes services, sometimes some sort of product. It's typically some sort of intellectual property, okay? And then interest expense. Interest expense is, so I take out a $150 million loan to buy that, to build that new building, right? The bank is not going to do that, or the bondholders, because it's 150 million we talked about, probably too big for a bank to finance. But we're going to have to pay interest to our bondholders. So if we issued 30-year bonds to finance our $150 million acquisition of a new building, or building of a new building, we would maybe float 10% bonds. We would have $15 million in interest expense every year, just using simple numbers to, you know, 10%, a 10% bond, you're going to pay 10% interest on the amount that you borrowed. So if you had a $150 million loan and you had your rate was 10%, your interest expense each year would be $15 million. Okay? I'm being super simple on that example, but your organization is going to have lots of different loans covering lots of different equipment, and those will all add up to the organization's interest expense in a given year. Okay? What doesn't go in interest expense is repayment of principal. So if you have a car loan and you look at the statement from your lender, it's typically going to say this portion of your payment, you have, let's say you have a $200 payment. At the end of the month, it'll say something like, this payment breaks down into $150 in interest and $50 in principal, right? Have you seen anything like that on? No? Yeah, okay. When you buy a house, you know, and you get a 30-year mortgage, you're going to have like a $2,000 payment, and I'll be a little silly, but, you know, $10 is going towards principal and $1,990 is going towards interest in the first, you know, in the first payment. And then gradually it becomes more and more goes towards principal and less goes towards interest. We'll get into that. We'll get into that next semester. It's so you have a principal payment. Typically, you have a principal payment and an interest payment. The only thing that shows up on the income statement is the interest portion of the payments. So even if I made $200 payments over the course of a year, so $2,400 in total payments, if I held constant, $50 each time was principal and $150 was interest, that would wind up being $600 in principal and $1,800 in interest. What I would report on my income statement would be the $1,800. I would not report the payment of principal. That shows up later on the balance sheet. I keep talking about the balance sheet. We'll get to it. So this line is only interest expense, right? The repayment of principal is not an expense. So that's there. All right. And then I told you to hold in your mind for a moment the dish payment and the idea that what the government giveth, the government can taketh away. So the way that dish payments are funded, in part in New Hampshire, is the state writes a check, right? writes a check for the dish payment of 12.9 million, and then it taxes hospitals to fund the dish payments. And so in this case, Wentworth paid 15.8 million, right, in New Hampshire Medicaid enhancement tax, and they received 12.9 million in dish funding. So as you can see, they wind up being a net contributor to the dish payment system, right? They received 13, they received 13, they paid, what did I say, almost 16. So they will net out about $3 million to the negative. So they're contributing about $3 million to the Medicaid enhancement system, the dish payment system. Why would that be? Yeah, Caitlin, question. Yes. Yes. It's based on, exactly. So Caitlin's saying, what do some hospitals wind up netting, right? Do some hospitals get a bigger dish payment than their tax payment? The answer is yes. If you go, so Wentworth Douglas has the good fortune of being located in one of the wealthiest areas in the state. There are a lot of poor communities, some of which some of you are from, right, where the proportion of people who get their health care through the Medicaid system is much higher than it is in Seacoast, New Hampshire. Seacoast, New Hampshire is relatively, even if you're from here and you're like, I'm not wealthy, actually, relatively speaking, your community is quite wealthy relative to, say, if you go up to Coos County, or, it doesn't even have to go up that far, right? Go up to the Lakes region. The people who actually live in the Lakes region are not very wealthy. It's all the wealthy people that own the vacation homes around Winnipesaukee that are super wealthy, but the people who actually live there and do the lawn maintenance on the huge houses on Winnipesaukee and all that kind of stuff are not particularly wealthy. So like LRG, which is the hospital up in that area, runs on a very high level of Medicaid and Medicare. And they're struggling because of it, right? Their payer mix is terrible. Whereas Wentworth Douglas and the Seacoast area, we have people who have good jobs that pay well, a lot of wealth in this area that you wouldn't realize. I mean, think about, you guys have seen, what's that place called? Riverwoods, right? That the continuing care facility. It's got a nursing home and a assisted living as well as like independent living. So it's this thing you move in when you're still healthy, and you pay a huge fee to move in, and then you pay rent. But when you start to get sick, they move you from the independent living to the assisted living, where they provide you some basic services like bathing and non-medical kind of supports. So you can't bend over to cut your toenails anymore. So somebody comes in and clips your toenails. Somebody does your laundry, that kind of thing. Then when you actually need medical care and you can't take care of yourself anymore, they move you to their nursing home wing, right? And so you live in Riverwoods for the rest of your life. That's the idea. Anybody know how much it costs to move into Riverwoods? A lot. Give me a number. Anybody have a number? 400K, too low. Yeah, exactly. It's like 750 is what last I heard, 750 to move in. And then I think it's, depending on the size of the apartment you get, it's like $5,000 in rent. And the place is full with a waiting list, right? There's a lot of wealth in the Seacoast area that you wouldn't necessarily know, because New Englanders are pretty good about hiding it. They, not hiding it, but being subtle about it. So Wentworth Douglas has the benefit of having a lot of people who can actually pay their medical bills and don't rely on Medicaid. So other areas of the state where others, particularly up in the North Country, right, are much poorer. All the mills are gone, so all the good jobs left a long time ago, and so there's a high concentration of Medicaid beneficiaries up there. Right? So that's what this does: is it reallocates it. It is a system negotiated with the hospital system that basically allocates some revenue from the wealthier hospitals to the poorer hospitals, is essentially what this mechanism does. And it is based on, as Caitlin was saying, based on the number of Medicaid patients. Really, it's based on the amount of services provided to Medicaid patients, not so much the number of patients, but the amount of services rendered. So there's that interesting line. Okay, so we've talked about so far the operating revenues that come into the organization based on its ongoing operations, right? So these are in non-for-profit terms, unrestricted revenue and other support, right? Which I'm going to say operating revenues. I want you to remember operating revenues, because if you can remember that, it's operational. It's from the operations of the core business. Then we talked about the operating expenses. These are the expenses that are associated with creating the operating revenues. So we're having this matching process of, okay, we generated $329 million in net patient service revenue. It cost us $148 million in salaries this year to provide those services, right? So we got this matching thing going on. And we spent $102 million in supplies to provide that $322 million in services. So on and on and on, right? So we're matching together the revenues that we earned this year and the expenses that we incurred to generate those revenues. So that's what this second section is the expenses incurred. Some of those expenses are not actually cash expenses, right? Which line here is not a cash expense? Which one of these lines does not represent the CFO writing a check to pay a bill? Allie? Nope. You really got to write a check to Aetna for the health insurance.
Is it depreciation?
It is depreciation. Thank you. It is depreciation because we really spent the $150 million in the year we built the hospital, right? But we're going to be charging ourselves a notional 3-point-something million each year after we build the hospital in depreciation. But it's not actually a cash outlay. We already spent the $150 million, right? So 10 years from now, we'll still be allocating ourselves 3-point-something million in depreciation. So what that line is meant to do is say, we all know that we really spent $150 million 10 years ago. But this year, we're allocating 3-point-something million in depreciation expense to represent the economic resources that we used up this year to generate this revenue, okay? So that's going to become important when we talk about cash flows. This is one of the ways that accrual-based accounting is different than cash-based accounting. Remember our discussion from a couple of classes ago. So this is one of the ways that accrual-based accounting misrepresents the actual cash status of an organization. And cash is really important because if you don't have cash on hand, you can't pay your bills. Okay? And that's one way to go bankrupt is you may have all this great, revenue booked, right? But if you're not actually collecting it, it does you no good. So you have to, because the employees that are earning their $150 million in expenses really want to be paid on a cash basis. When payday comes, they expect to see a deposit show up in their account. They don't want it to be like, well, we haven't collected the revenues yet for the visit with Mrs. Jones, so we'll get that to you as soon as we get the payment from her, we'll get it to you. No, that's not how employees think. They're like, no, I worked my 40 hours, give me my money, right? Okay, so we've got operating revenues, operating expenses. The last section, I said there's 3 sections. The last section is non-operating gains and losses. Sometimes you'll see it broken out into operating gains, operating losses, non-operating gains, non-operating losses. So it looks like there's 2 sections. That's okay, it can be done, but really generically, there's a 3rd section and it is the combination of the 2. But you could present it as 2 separate sections, but they're really kind of lumped together because they're the non-operating portion of the organization's money and economic value flowing in and out. So some examples. Unrestricted gifts and bequests. This is donations to Wentworth Douglas in this case. It is those are considered non-operating gains. So they had $413,000 donated directly to the hospital. They also, by the way, have a charitable foundation that most of their donations flow into, and it's a little bit of funkiness, but it's all part of the same kind of system. A lot of large hospitals have a foundation, so like Elliott has, Elliott Hospital, and then it has the Elliott Foundation. And so most of the donations flow in through the foundation, and then it flows from the foundation. The foundation basically donates, buys big equipment for the organization, that kind of thing. So anyway, Wentworth Douglas got directly donated to the hospital $413,000. They didn't earn that by providing patient services, right? It was a donation. So it's treated typically, but not always, typically treated by community hospitals. The donations are treated as non-operating gains. Yes, ma'am. Great question. I think it would be treated as income, but I don't know 100% on that. Yeah, if you were to make a donation to Portsmouth Regional, for example, Portsmouth Regional is a for-profit entity. I didn't hear the first part. Yeah, so Emma said when you win the lottery, you pay. Yeah, that's treated. So yes, when you win the lottery, that's treated as ordinary income as an individual. But we're not non-for-profit entities, right? So yeah, so if you won the lottery, it's not really income. If you are wealthy and have a bunch of investments and you get paid dividends, for example, from stock that you own, that's treated as ordinary income and would show up on and you would have to put that into your tax return. Absolutely. We're gonna get to that in just a second. That's the next line down, as a matter of fact. So hospitals, not-for-profit hospitals in particular, because they're not paying taxes, a portion of that money they save and set aside to help fund new building funds and things like that. So when we look at the balance sheet for not-for-profit hospitals, you're going to see a large amount of, often a large amount of money set aside in the form of long-term investments. So kind of what you just described. For-profit entities typically don't hold as much in terms of investments as not-for-profits do. And there's a bunch of economics behind that I don't have time to talk about. But just so you know, so we have that first line of donations, unrestricted gifts. So these are gifts without strings, right? And they're counted in the year that they're given. So Emma has a great experience at Wentworth Douglas. She says, I'm a student, I'm a poor student, I don't make that much money, but I really appreciate how good, the services were that I got from Nurse Erin. So I want to make a little donation of $20 to, the family practice clinic here. That money flows into the hospital, and she doesn't say, oh, and you can only use it, for this particular purpose. She gives an unrestricted gift. That $20 goes in, and it is used in the year that it is counted as non-operating gains in the year that it is given. Okay, so we've got that. Then we have what Emma was just talking about, investment income. So Wentworth Douglas has a large amount of money set aside in the shape of investments. That first line refers to investment income. So Wentworth Douglas invests some of its money in investments that yield what is considered ordinary income, kind of what we were just talking about, dividends, interest. So maybe they own bonds in other organizations. And so being a bondholder, they get paid interest on the bonds that they own. So they have effectively made loans to other organizations with some of this excess money that they've held on to. So interest and dividends are two of the most common forms of investment income. So this is money flowing in. You're not buying or selling the investment. You were just holding it, and it pays you interest. So if you bought a bond, right? If you bought a federal government, a U.S. Treasury, a bond from the U.S. government, and it paid you 3% per year, and it was a $1,000 bond, you would get a $30 check every year from the federal government. Probably actually two $15 checks, but you would get $30 every year. That is investment income, and for you personally, it is considered ordinary income. Yes. Yes. Nonprofit hospitals are allowed to do that. They do that all the time. So they may own Wentworth Douglas. I don't know. I have no idea what their investment portfolio looks like, but they clearly own something that pays interest and or dividends. So they may own some federal treasury securities. They may own some other kinds of investments that pay some sort of income. They collected in this year $4 million in investment income. Okay, so that's income from just holding an investment. That's different from the next line, which is net realized gains or losses on the sale of investments. So there's two ways that you can make money by investing. One is you can buy investments that pay out some sort of dividend or interest. So you can buy a bond and collect interest on that bond. You can buy stock, and that stock pays dividends. Now, stock is probably the most obvious. You guys all know stock prices fluctuate every day. You hear on the news the Dow Jones closed at 27,000 this day. The Dow Jones is down by 12% to 22,000 today. President Trump is very upset about the Dow having gone down and is scolding businesses for wants to get them back to work or whatever. Being a little bit silly, but you hear that all the time. So if you bought stock in, say, General Motors, I believe they pay dividends. If you bought a share of stock in General Motors, let's say it was $50 a share. You bought it at $50 and it was paying a $1 dividend. As long as you held on to the share of stock, you would get $1 in dividends every year, 25 cents a quarter, let's say. So for every share you own, you get a check for 25 cents every quarter. So at the end of the year, you wind up with $1. That would go into that first line, the investment income. You bought General Motors at $50, and then the next day, the CEO announces, we have come up with a battery technology that's going to allow us to make faster, cheaper, better electric cars than Tesla does. And the market goes nuts, and the stock price goes from $50 to $200, right? You, instead of holding on to the stock, you decide this is enough of a gain for me, and I don't trust that they're actually going to be able to deliver on what they're saying. So I'm going to take advantage of the market's excitement about General Motors, and I'm going to sell my stock. Well, you bought the stock for 50, you sell it for 200, and so the difference between those is a gain of $150. So that's what's being described here, and that is called a capital gain. And so when you own stock, for example, you are hoping for two things. One, income in the form of dividends, and two, capital gains. So you need to know that organizations have investments, and those investments pay income, which is dividends and interest typically. There's some other ways, but those are the two primary mechanisms whereby an organization earns income from its investments. And then an organization can have gains or capital gains. So that's what this refers to as capital gains or capital losses. So you bought it for 50, you sold it for 200, you have a capital gain of $150 per share. I bought one of my great, brilliant investment decisions that I wish I had poured every dollar that I ever owned into was back in 2008. Amazon had fallen to something like $80 a share. It had been like 200, it fell to 80, right? So I bought, I don't know, how much did I buy? 100 shares, something like that. No, it was less than that, but whatever. I bought a small number of shares because I didn't have a ton of money, but I thought, no way Amazon it has lost half its value, because, even in 2008, I was getting packages from Amazon like every other day. So I bought some shares of Amazon. Fast forward to today, how much is Amazon stock trading for? Anybody have any idea? Something close to $2,000 a share.
3K.
So, yeah, we'll say again?
3K. 3,100.
3,000. Yeah, 3,000. Nice. So my investment went from $80 a share to $3,000 a share. So I have, and I still own about half of it. I sold some of it when it hit like over 1,000. I was like, all right, now it's time to get out at least some of it. So I still have about half of my original investment. I wish I had bought about as many shares of 80 at $80, but you just don't know. I mean, if it was that obvious, it wouldn't have fallen to 80 to begin with, right? I had some gains, so I sold some of those shares at about 1,000, so I made $920 in capital gains, right? Really brilliant. I've also bought some really dogs that I've actually bought some, like Vlasic Pickle got spun off from Campbell's or something like that. And I'm like, I love pickles. So I bought 100 shares of Vlasic Pickle at like $5. It later went bankrupt and my investment went from $500 to zero. So I brag about my Amazon investment, but I have plenty of dogs that I've also bought. So it is possible to have a net realized gain. So if Wentworth Douglas had bought Amazon back in 2008 and they were holding it to today, they sold it to today for $3,000 a share, they would have had $2,920 in recognized gains. If they had bought Vlasic Pickle back in 1998 or whatever it was that I bought it, at $5 a share, and they held it and weren't paying attention, and the firm went belly up, they would have lost. They would have a net realized loss of $500. So the stock market is not predictable, and your investments can both gain or lose. And sometimes, I'm not going to get into it, there's a bunch of tax implications and stuff. What I just want you to know is you can have realized gains and losses on buying and selling investments, and then you can have income. So those are two things you need to know.
Can I ask a question?
Yes, ma'am.
So how would you get the profits back from your, not bonds, what are they called again?
Stock?
Yeah. Would you have to sell them to someone, or does it work like similarly to bonds where Amazon would pay you back at like a coupon rate?
Okay, so stock is, and actually bonds as well. So with bonds, the organization that sold the bonds is paying you interest. But if you want to get rid of those bonds, you sell them to somebody else in the marketplace. The organization that issued the bonds may or may not be interested in buying the bonds from you. But there is a market, right? There's a bond market where, Saffron, if you owned bonds in Wentworth Douglas, so they have bonds, and you're like, you know what, I need this money to go do, I need it to, fund something else, or I want to have a different investment. I'm going to sell it. And Chloe might say, I'll buy those bonds. And you would buy them. You could sell them on the bond market. Same with stock. So if you own Amazon stock, and you say, you know what, 3,000 is pretty good. I don't think it's really going to go much higher than that. Or even if it is going to go somewhat higher, I still want to rebalance my portfolio. I want to sell it. You would call up your broker, and your broker would sell that stock to another investor on your behalf, and the money would be transferred by the broker from the buyer to you. Does that make sense?
It does, yeah, thank you.
Okay, so it's basically like, I refer to it as the stock market is like a used market for used, or is a market for used stock, right? You're buying and selling stock that's been issued. It's not new, right? Emma maybe bought the original IPO in Amazon, and she's like, I've made enough money on Amazon. I want to unload some of it so I can buy some new upcoming stock. So I'm going to sell my stock now. She calls up her broker and says, sell my stock. The broker and the broker has an order from Allie to buy Amazon. So the broker arranges the sale between Emma and Allie. That's how the stock market works. Do you have to go through legal channels to do that? So it's a highly regulated process. You don't need any lawyers to get involved with it. There is a regimented legal, well, that's a little bit different, right? So that's a little, yeah, so. Well, we don't need to do it under the table. It's a pretty standardized process. You call it, I mean, I could show you how to buy, I could pull up a brokerage account and show you. It's really a couple of clicks and you're done. So there's no, it becomes a little more complicated if you are trying to gift stock and things like that. Or gift it to a minor, that becomes or you become of age. That's a whole other kind of thing. All right, I've got 15 minutes and a couple more points I need to make. So let's keep going. Wentworth Douglas has some joint ventures. Don't worry about joint ventures for this class. I'm just, they're a real organization. Loss on extinguished debt. This is another example of something where they paid off their debt early, and so they had to maybe pay a penalty to do it, right? That's not my point here. Is none of this is related to patient care, right? Choosing to change how your organization is financed has nothing to do with patient care. So that's the key takeaway from this section is this section is where economic activity that the organization is engaged in that doesn't have anything to do with their core business, which in this case is patient care. That's where all the kind of results of that go. So they changed the way they were financed. Okay, that has nothing to do with providing patient care, but it still cost them something. And so that goes here in the that's a non-operating loss. Okay, investments, nothing to do with patient care. So that goes down here. Changes in the way they're financed. An interest rate swap is a financing move, and I'm not going to talk about it. Just understand it has nothing to do with patient care, so it belongs down here, right? It really cost the organization something, or in this case, they made a profit on it, but it is really something that they. But it has nothing to do with patient care. And then community benefits and other. So remember, not-for-profit hospitals got to provide community benefit. So in this case, they maybe made donations, they maybe ran a homeless clinic, something like that. That's what this represents. Okay. So these are, or maybe they ran some sort of education event, something, whatever it is, lumped in there, not part of direct patient care. So that's why it belongs down here. So those are the three sections. Operating revenue, revenue coming in from the core business. Operating expenses, expenses associated with providing the services that generated the revenue from that line above, right? We subtract operating expenses from operating revenue to get operating income. That's important to remember. Operating income. That is a measure of how effective the organization is at generating income from its core business. Then you have your non-operating gains and losses. This is stuff that isn't necessarily predictable. It isn't, but more importantly, it isn't directly related to the core business of the organization, right? And then we wind up with this last line. So we take operating income, we subtract the non-operating gains and losses. Sorry, in this case, because it's a positive number, we add it. So in this case, they had 8 million in operating gains. We add that to the operating income, and that gives us in non-profit speak, that gives us excess of revenues over expenses. In for-profit language, that gives us our net income. I'm going to default to net income because saying excess of revenues over expenses takes me too long to say when I can just say net income. But you should know that not-for-profit entities use slightly different language on their financial statements. It means the same thing, okay? Net income is just the residual. Remember, we talked about that before. When you're an owner, you are a residual claimant. So the net income is the residual after the organization, the residual of revenues minus all their expenses, right? That then accrues to the owners. Now, Wentworth Douglas is owned by the community at large. So that money is all going to be retained by the organization because they're not for profit. If this was a for-profit, that $27 million, the board of directors could say, we're going to keep all $27 million of it and reinvest it in the organization, or we're going to keep 17 million of it and pay $10 million out in dividends, right? Not-for-profits, they have the non-distribution constraint. They are not allowed to distribute their profits because there are no owners to distribute it to. Okay, so that's a key point that I want you to take away there. All right, so we've got that. All right, so let me just jot those numbers down. I'm going to stop sharing. All right, gangsters, hang on 1 second. We'll flip us to our. All right, so we said, 1 second, revenue was 352, off expenses was 333, income is 19-ish. I'm just doing real simple numbers here. Non-op is 8, and then net income of 28. Okay, so this is just a summary of the last slide that I had for you. I need to teach you now 2 ratios in the time we have remaining. 2 ratios. The first ratio is operating margin. And I'm going to abbreviate op margin. And operating margin is operating income divided by operating revenue. And so it's pretty simple. So it's just going to be, and bear with me, I know these are not the precise numbers. You do want to use the actual precise numbers, but operating income of 19 divided by 352 gives us a 352 divided by 19 divided by 352 gives us 5.23%. So operating margin is, you're going to need to know how to calculate that. Operating margin, I will give it to you for the test. I will give you the formula. So you just have to remember what this means. So let me cover operating margin and then profit margin is net income divided by total revenue. What is total revenue? Is equal to op revenue plus non-op gains or losses. So in this case, the non-op is positive. If it was a negative number, we would subtract it. So we're going to take net income, so profit margin is going to be the net income 28 divided by 352 plus 8. So that's going to be roughly 28 divided by 360 in this case. And yes, I am super rounding to the nearest thousand. So this is not completely accurate. 28 divided by 360 of 7.8%. Okay. So two ratios you need to know from this chapter are operating margin and profit margin. Both of them measure how effective the organization is at cost control. Why is it cost control? Well, operating income and net income, right, are both represent the residual of what is left over after you've paid all your expenses. So you're going to have a higher, numerator, right, the number in the top. You're going to have a higher numerator if you do better at controlling your expenses. So for the same amount of revenue, you will have a higher amount of profit if you can make your expenses go down. So this is typically looked at as how effective is the organization at controlling its expenses. Now, what's the difference between profit margin and operating margin? What's your intuition? What goes into the operating? What? Good. It's the Emma said it's the non-patient stuff, right? So the profit margin captures the non-patient, in the case of a hospital, captures all the non-patient related economic activity. The net income really matters, right? It's not that it's irrelevant, but it doesn't. But it takes our eye off of how effective the top 2/3 of the statement indicate the organization is actually being. It is possible for you to have a negative operating income and a positive net income. In fact, that happens. It has been happening a fair amount in some of the smaller hospitals up in the North Country. I had a CEO a couple of years ago come in to talk about that from one of the small hospitals, and he said, "Yeah, we had a negative operating income. And you have a negative operating income by having your expenses be bigger than your revenues, right? So I have a negative operating income, but I have a super smart CFO, and she's been able to generate a whole bunch of investment income, and so our investment income has offset our operating losses. And that's all great, except that the market is a fickle thing, and for these couple of years, your investments might be paying out well, but at some point the market turns, and you cannot rely on that in the long term. So an organization, I see you, hang on. An organization that has a negative operating income is in serious operating danger, right? The core business is not functioning properly for whatever reason. The core business is not functioning properly. That might, in healthcare, that might be because we've had a change in the way we are billing or something, or being reimbursed. So it might not be the fault of the organization, but the reality is the core business is not operating correctly. And a good non-operating profit or non-operating income can hide that fact. So we want to look at both, right? They both address important issues, but the operating margin really helps you capture the effectiveness of the core operations of the business. The profit margin tells you the overall economic health. So they're both important, but they tell you different things. They are both related to cost control, but they tell you slightly different things. Emma. Yeah, so if you've got so the question is, what can they do with the profits? They can do anything as long as it's within their mission. All right. They wouldn't be able to break ground because they would need investors to pay for it. But yeah, they can use the money they can use the money if it's a donation or profits. They can use the money however they want, as long as it's consistent with the mission of if for not-for-profit, as long as it's consistent with the mission of the organization. All right, good. I think we've got one little thing to do next time to finish up chapter 3, but we're otherwise pretty good. All right, gang. See you next week.